Hello guys, thanks for joining me once again on Time Out with Yomi Martins, and I'm your main guy Yomi Martins from the city of Lagos, Nigeria. See, I don't want to talk too much. I just want to give you one hot gist. I'll tell you what happened today. A friend of mine actually came over. He was worried. He just started off a new business and he was running into so much challenges as regards financing his new business. So he actually just came up to me and told me that, Yomi, why is it that all banks are turning me down? I go to the first one, they tell me they can't finance my business. I go to the second one, they tell me they can't finance my business. So what am I actually going to do? He was really worried. But I told him, sit down. If you want to find out the solution I actually gave him, relax and watch till the end. I'm sure you will learn a thing or two. Whether you are starting off a new business or you are trying to grow an existing one, I'll give you 5 major insider tips on how to get bank loans. Whether in Nigeria, Europe, America, Asia, Australia, any part of the world you are in, I will give you 5 major insider tips on how to secure a loan, whether you're starting up the business or you're growing the business. So make sure you watch to the end. And before I continue, please do me a favor. Smash the like button, smash the subscribe button, drop me a comment, and also share to your friends. Let's start. Now, for starters, some of you might actually be wondering, why should you be listening to Yomi Martins? Now, I'll tell you why. I actually have over 24 years of banking and financial services consulting. I've worked with various international banks. I might not need to tell you the names right now. So, I'm actually the go-to guy when it comes to financial literacy and banking matters. Because 24 years, I guess you tell me, that's not a joke. The number one point I'm going to start off with is character. How is character? Character is one of the major things banks consider when they are giving you a facility or a loan, as the case may be. Who are they giving the loan to? What is the tendency of the person paying back that loan? Does that person have the right reputation in the first place? Is that person a known fraudster or he has a shady character? Those are things they consider. Now, let's go a step further. The banks will also consider your credit history is part of character, because your credit history will actually show whether you have a tendency to default or not. The world over, there are different credit agencies that actually give you credit ratings. In Nigeria, we have the credit bureau. In America, they have their own credit bureau as well. Same applicable for the United Kingdom, Australia, Hong Kong, wherever part of the world you are in. So the banks will first assess your character historically and your reputation in the locality before they actually consider giving you a bank facility in the first place. Now, with that out of the way, what next? This brings us to point number 2, which is capacity. Capacity has to do with the borrower's ability to repay the loan. The bank needs to evaluate what you are using the money for in the first place and whether you'll be able to pay back the loan as at when due. That is very, very important to a bank, because the money the bank is lending to you does not actually belong to them. They are depositors' funds, and they need to ensure that they get those funds back into their books. So they will need to evaluate the kind of business you are doing and whether that business will be able to pay back the loan. Those are the critical credit evaluation they will do. Okay, let me give you an instance. If you are borrowing money to set up a factory, a new factory, right? They need to look at it. Let's say, for sake of discussion, you want to set up a bakery and you have borrowed X amount. For sake of discussion, let's say $10,000. Now, by the time you use that $10,000 in buying your fixed asset and spend on your operational costs, right? Like buying flour, buying the oven and stuff like that, they also have to assess how much will be your sales projection. And over the period you are taking that loan for, would you be able to pay back that loan as at when due? That's critical for them. So if you are taking a loan for 1 year, you need to be able to prove that after making all those expenses, you will be able to pay back when the loan falls due. So capacity is very important to the bank. I hope you get that. At number 3 is capital. Capital has to do with the borrower's own commitments. More often than not, depending on the kind of business you are borrowing money to do, the bank would, more often than not, as I said, because there are always exceptions to the rule, the bank will want you to have your own commitment to the venture. So you are not actually just borrowing all the money from the bank. They want to see that you are also putting something on the table. You are putting your money where your mouth is. So let's say for sake of discussion, you want to set up a factory, like I earlier said. The bank will want to know, how much do you need? Let's say $1,000 or $10,000, as the case may be. The bank will want to know, how much of that money are you willing to put down? So that they will know that you are committed to that venture itself. Because if you are not putting down anything and it's the bank putting down all the money, the tendency is that when the business or the venture goes south, the bank is the only one going to suffer it. So the bank will want to ensure that you have your own capital committed to that venture in the first place. As I said, more often than not, because there are exceptions to the rule. Exceptions to the rule, we can now start talking about things like authority to collect, ATC, right? And for authority to collect, the bank actually warehouses the goods, right? And gives you in milestones while you pay as you collect. Those are very, very familiar scenarios in fast-moving consumer goods and stuff like that, in which they can actually, hold physical goods in a warehouse and they'll give you a document to go and collect those goods. So in some cases, you might not actually need capital to finance, a project, right? So you need to there's what they call creative financing. You need to be creative about structuring the facility so that all parties, both the lender and the borrower, are well protected. I hope you got something from that, right? Now, coming up at number 4 is collateral. Coming back home to Nigeria, there's what we call the CBN Prudential Guidelines. Now, the CBN Prudential Guidelines explicitly stated, right, that all facilities or loans given out by any financial institution, that is to say, banks, must be collateralized. That means there must be an asset to back up the imminent or possible risk that might result from the loan going bad. So in essence, let's go back to our previous example of you wanting to set up a factory. The bank will tell you, okay, Mr. John, do you have a property? Now when you say yes, What is the value of the property? For sake of discussion, the property is worth $20,000. Now, how much do you want to borrow? If you say you want to borrow $25,000, that won't work. It won't work at all. The property must be substantially more valuable than the amount you want to loan. Do you understand? Do you want to borrow? It must be substantially more valuable than the amount you want to borrow. So if you have a property worth, for sake of discussion, $20,000, the bank can tell you that they can't borrow you more than $10,000. That means they are adequately covered, because the worst case scenario, if it goes bad, the loan goes bad, they have a $20,000 property that they can use in covering it. But mind you, because you have a $20,000 property doesn't guarantee you that the bank will lend you the money. It doesn't at all. Because other conditions that I've mentioned right now has to be put into consideration. So your collateral is not a guarantee that the bank will borrow you money. The bank is not in the business of selling properties. And property is not the only collateral you can use. You can actually use so many other assets. You can use deposits that you have in some other bank that you don't want to touch. Probably you have placed it in treasury bills or something like that. So there are various ways you can actually create collateral. Now, that is on one hand. Now I know some of you, for 1 minute, you'll tell me that no, it's not all loans that are collateralized. You are very correct. Now, that's where it brings us back to what I talked about earlier, which is creative financing. What is creative financing all about? Ensuring that the facility is packaged in such a way that mitigates the risk on the bank. Now, let me give you an example of a facility that can be given out to you without you having any form of collateral. And that's your salary advance. The salary advance is hinged on the fact that your salary in the first place is domiciled in the bank that is advancing you that loan. So in essence, they are very sure that if they give you a loan on, for sake of discussion, on the 2nd of January, your salary will come in at the end of the month in January, and they will take that money from them, from your accounts. That's on one hand. Now you might say, what about if the person loses his job? For most salary advances, they have a double layer security on it. And what's that double layer security? They would have gone to sign an agreement with your employer that your net indebtedness will be paid by them from the amount due to you when you leave the organization. So you see, it's foolproof. At number 5 is conditions. Conditions, what am I talking about? Those are the requirements you need to fulfill, apart from the 4 requirements that I've mentioned earlier, which I've said before. I've mentioned capital, collateral, character, and all the rest of them. You need to meet conditions. And in banking, what they call it sometimes conditions precedent to drawdown. That means conditions you must meet before you have access to that money that you have been given as a loan. So in essence, the conditions might include you providing collateral, which I've already mentioned, you providing a guarantor or surety, right? Those are part of the conditions. Your conditions might also include you providing or executing a legal mortgage on the property that you have put down as collateral, right? Conditions can also include you making sure that even when the loan is advanced, you periodically pay back in installments. That is, if they do not give you a moratorium period, right, before you start paying. For those who don't understand what I mean by moratorium period, that means a period of leave in which, okay, don't pay for this period. For instance, the loan is granted in January. They might say, okay, don't pay anything until March. We are going to give you a 2 months breather so that, you are able to implement what you said you are going to use the loan for in the first place before you start paying back. Now, have you learned something? And I'm sure you now see that this might be one of the reasons why my friend was not able to get a facility from a bank in the first place. He might have not ticked every box appropriately. Getting a facility is not rocket science. Getting a loan is not rocket science. You just need to ensure that you meet all the requirements or use creative financing, because there is always a way about all these things that I've talked about to make sure that the bank is protected and you are protected as well. Before you go, make sure that you smash the like and subscribe button. Drop me a comment if the content actually educated you on a thing or two about banking, finance, and being able to access a facility from a bank. Until I meet you again, I remain your guy, Yomi Martins from the city of Lagos, Nigeria. Bye for now, and don't do what I won't do. Take care of yourself.